Hello, everyone. Welcome to The Exchange, a podcast powered by Everbloom that explores the institutional landscape of cryptocurrencies and blockchain technology. I'm your host, Manasi Vora. Today, we are sitting down with Patrick Murck. He's a special counsel at international law firm Cooley LLP, where his practice focuses on regulatory and legal issues facing fintech industry. He's also affiliated with the Berkman Klein Center at Harvard, where he researches law and policy implications of Bitcoin and blockchain. He's held multiple roles over his career as a startup employee, advisor, angel investor, entrepreneur himself. He's one of the most influential figures in the Bitcoin space, having co-founded Bitcoin Foundation in 2012. Thank you, Patrick, for sitting down with us today.
It's my pleasure.
Let's get started. So you've had a long history with Bitcoin and cryptocurrency. What got you first interested, and how has your role evolved since?
So it's interesting. I got interested. I was a early employee at a startup in Seattle, and we were working on virtual economies and digital currency for the internet in general, and like publishers and things like that. It was obviously a centralized virtual currency. It was not a Bitcoin style thing. I joined in 2009, that company.
Oh, wow.
Yeah, I know, right? And it was around 2010, probably when I got the first slashdotting, right, of Bitcoin. One of the engineers who was there came over and said, hey, you should check this out. And it was the Bitcoin white paper and, the Slashdot article and all that stuff. And I read the white paper and I said, oh, well, whatever, some nerds want internet money, good luck with that. And I pretty much dismissed it at the time.
So you were skeptical.
It didn't really pique my interest, right? And we were doing our thing. I jokingly said to our CEO that has just open sourced our business model because we were going to be the reference currency for the internet, which we were not, as it turned out. And when I left that company in 2011, some of the Bitcoin people reached out to me. I was just helping out some, local people that I knew, kind of taking a little bit of a break and from startup life, which is crazy, right? And some of the Bitcoin people reached out, John Matonis first, and then some other people. And they were like, you're a lawyer, startup guy who knows digital currency regulation. In like 2011, they were like, you're a unicorn in the forest. Like, come and be a part of this community and help us out. And I just got drawn into it. And slowly at first, but then finally enough people kept approaching me. I revisited that white paper and took another look, and I read it, and I realized that I had kind of missed something the first time through, right? I focused on sort of the payments architecture, like, well, let's have, peer-to-peer payment system and those kinds of things. And I grokked that, and it was sort of interesting. Then I realized there was a precedent idea to that, right? Which is that in order to have that, you need to build a system that can create these unique digital objects that are rivalrous to other digital objects. And the rivalrousness isn't guaranteed by a private actor. It's guaranteed by this digital commons.
Yeah.
And that's when the light bulb went off, and I was like, whoa, this is property. This isn't about payments or anything like this. We're creating like real, true digital property. And from that point forward, it was like down the rabbit hole I went and never looked back.
Yeah.
Well, I look back, but yeah.
That's exciting. I mean, you've been in the space for really long now.
Yeah.
And you also serve on the IMF's FinTech Advisory Board with other prominent members from US Treasury, People's Bank of China, and other members. What is your role there, and what is the conversation like at the IMF?
Sure. So I'm a high-level advisory group or whatever. It's very interesting. It's a great opportunity for me to learn from some very smart people, including the fund themselves, and share ideas and things like that. But that's really what it is. It's information sharing. So I think the fund has done a really great job of bringing a diverse group of people and voices together, putting them together and allowing them to share information with the fund. What the fund does with it, that's what the fund does with it. Although, the comments that have come from the fund, the work product that's come out of the fund,
pretty positive.
It's been pretty good.
Yeah.
Right? Not just positive, but like good. Like substantively, it's been good and also positive. So it's like, that's nice. That's a nice combination. And that's been great. So it's been a good experience, and it's been a lot of information sharing and things like that. I think they've done a great job of it.
So you meet annually? What's that like?
I meet when called upon.
Okay.
But it's been about annually, roughly, as we have meetings of the group, and then there'll be informal like calls and things like that. That's right. So it's not a everyday kind of thing. But it's been great.
That sounds great. Let's move to your favorite topic, regulation.
Yeah.
Do you think regulatory blockchain environment in the US has been confusing so far and has caused it to fall behind with the rest compared to the rest of the world?
It's been confusing. Yes, for sure. I think a lot of people have struggled to really grasp what the regulatory perimeter is around different types of products and offerings and services and things like that. So I think that it has been a little confusing. Some of that is just the need for regulatory clarity and regulators getting up to speed, which is to be expected, right?
It takes time.
It takes time. It has to be worth it from a regulator's perspective. It has to be worth it for them to invest the resources to provide the guidance in the first place. And then it takes actual diligence and work to make sure that you're putting something out that's thoughtful, that doesn't inadvertently stifle innovation or have some other host of like external bad effects, and then do it the right way. So it takes time to go through a thoughtful process like that. That's understandable. But in the US, there's also a systemic issue, right? The regulatory environment for financial services is highly fragmented. It's not in other countries. In other countries, you have a little bit of a consolidated environment in terms of who your regulator is.
Right. So it's like a single body versus your multiple.
Yeah, single or sometimes two, right? But if you're working out of Singapore, say, you have the MAS, and that's your regulator pretty much for any activity you're going to conduct in the financial regulatory world. So if you need an answer, you know exactly where to go, and they can shape policy and do what they need to do. MAS has been very nimble for a number of reasons. One, it's smaller country and smaller market, but also they've invested in leaning into tech, and leaning into technology and fintech in general to maintain their position in the global economy. In the UK, you have the FCA, which isn't the only regulator that you have to think about, but it's your primary regulator, generally speaking, if you're involved in this stuff. And they have clear rules for the most part, not in every aspect, but for the most part, or they're developing clear rules. In the US, you have the SEC, the CFTC, the CFPB, the OCC, the Fed Reserve sometimes, the FDIC, Treasury. And if you're involved in payments or securities offerings, you have all 50 states potentially involved as well. So, you know, I mean, worst case scenario, you're a payments company that's issuing a token, right? And then you could have like over 100 regulators just to access the US market, potentially. Right. And that's
burdensome.
It's just crazy, right? Yeah. Like, and you're never going to have clarity in an environment like that. It's a structural issue. It's not about how much time it's going to take. The structure is just designed in such a way that you're never going to have a clear path.
But do you think this year we'll see some more clarity, given that the SEC just announced that digital assets is its own examination priority for 2019?
Yeah. So I think you're seeing in some states, some of the regulators taking a forward-thinking approach, leaning into technology and saying, you know, there's a lot of benefit here. We want to capture the benefit. We want to minimize the risk, but we want to make sure that we capture the benefit. And they're doing the same thing that IMF is doing, right? They're information gathering, they're sharing, they're bringing people in to share knowledge and things like that, so they can have thoughtful opinions. Not every state, but some states are starting to do that, which is smart. We're seeing it in Delaware. There's things that haven't been announced in other states as well. The SEC has said that they're going to publish guidance on token sales and on qualified custodians in custody. And those are obviously very big pieces. And again, it's part of a thoughtful approach, I think, that the SEC has taken over time to the space of really developing some knowledge around it and understanding what's happening before just publishing something that might inadvertently stifle innovation, even if they thought they were promoting it. So we'll see. We'll see what that
we'll see
is.
What happens.
I think it might have, I think their goal was to put the token sale stuff out in Q1, maybe. I don't, at least probably earlier than it's going to come out because of the shutdown. But it'll come out, I think, this year. So that'll be good.
Yeah, it'll be exciting to see what they come out with. But talking about token sales, so in November, we saw the SEC announce settled charges against Air Fox, Paragon Coin that sold digital tokens in an ICO. And prior to that, we had seen Massachusetts Securities Division and its ICO actions against sale of unregistered securities. So what do you, according to you, these actions signal to the market?
Yeah, well, I mean, I think they signal a few things, right? One, that there is a regulatory perimeter that captures at least some part of the token issuance and token sale. I don't think we're yet clear on exactly where the boundary is around that perimeter when you're in and when you're out. There is presumably a boundary where you can sell tokens that there aren't securities, presumably. But establishing it is it takes time, right? The other thing I think that the message to the market is that, so there's a regulatory perimeter, you may or may not fall within it, the boundaries of which are a little bit uncertain still, and we're still trying to figure that out. If you are, and I'm not suggesting anything about any of those companies you mentioned, but if you are a bad actor, right, you probably should not consider this to be just some Wild West space that you can enter and do all these things. There were some other enforcement actions that were clearly targeting fraud and things like that, where there were clear bad actors. And that's where I think the SEC spent most of its initial time. And I'm sure in Massachusetts, they're worried about the same kind of thing. Either bad actors taking advantage of that or opening up an opportunity for some sort of like regulatory arbitrage game, which nobody really wants to see happen either. You want to make sure there's a consistent floor for these types of offerings that protects investors from unscrupulous actors or, undisclosed risks.
So that's the main idea, protecting consumers and...
Well, protecting investors. Right. Protecting consumers is like FTC and CFPB and some other agencies. Again, fragmentation, right? And even in the state level, there are different people, but protecting investors. And the way to think about securities law in the US, particularly the SEC, is the SEC is a content neutral regulator, right? That's part of the whole like New Deal bargain that was struck when the SEC was formed, was that they can create fair markets if they enforce certain uniform disclosure rules. Right? If you have information as an investor and you choose to make bad choices and lose your money, that's on you as the investor, right? The SEC isn't going to bail you out for making dumb decisions, right? That's not their job. They're content neutral, right? They just want to create a floor that says this is the minimum amount of disclosure you have to do so that any investor who enters the market can make a fair decision of what the risk is and what the risk isn't that they're taking. And anything that hides that risk from investors, that's going to be problematic.
Definitely.
It's also a guidepost for a lot of people who are operating in the space who think that the perimeter is sort of hazy, whether they're in or whether they're out, and they would like to come up with their own best practices and things like that. Take that to heart, right? I don't think the disclosure regime for equities is necessarily the one that's going to matter for a payment token or a utility token or whatever they're calling it. But there might be other types of disclosures that are totally relevant, right? What's the amount held by a foundation, for example, or different entities in the space, right? Are there people with material inside information that could trade on that information? Are they disclosing their position and their sales and things like that? These are, I think, things that might actually not be captured in the current regulatory framework and the rules that the SEC has promulgated as designed today that should be captured. And I think we all probably agree that those things should be captured And we just need to come up with a way of doing it, whether it's through regulation from top down from the SEC or bottom up from the community through best practices and common standards.
Definitely. But do you think we can say most ICOs fall under the US securities law?
Well, Chairman Clayton seems to be of that opinion, depending on the day, I think. I think a lot of them did, but I think what's really important is to distinguish what it is that falls within an offering of securities, right? When you say that an ICO is a securities offering, it's not so much that the token is a security necessarily. It could be, depending on what the token conveys in terms of rights and what it does. But often what catches you up in the securities law is the offer and sale of the right to get the token, whether immediately or at some point in the future, right? That's the marketing and sale of the thing. That's the contract that becomes the investment contract, whether it's a written contract or an implied contract through action and words. That's the thing that tends to be the security. So you could have a situation where you have a token that trades freely today. The token isn't a security necessarily, but the sale of it did constitute the unregistered sale of securities that didn't fall within an exemption, and therefore there's an enforcement action. So I would not be surprised to see enforcement actions come down the pipe from the SEC where they say the sale of this token was an offering of securities, pay your fine, do those things, but the token itself is not a security because it doesn't convey the same rights that a security typically would. And
that'd be interesting, like a dichotomy to see. Let's talk about trading, right? So in the light of recent SEC charges against Ether Delta founder, what are your thoughts on regulation for exchanges and especially decentralized exchanges, which might be trading these security tokens?
Yeah, I mean, I think that case was really interesting. I mean, the one thing to keep in mind is that it was a consent decree. So, I mean, nobody went to court and proved any of this stuff, which is fair. I mean, that's the way most enforcement actions happen. And that's how guidance has sort of trickled out in the space. But what was most interesting about that was the SEC's and regulators in general are still trying to come to terms with what it means to be an operator in the space, right? When you don't have full control, when you aren't truly intermediating the process, right? Whether it's order book and execution, right? In that case, it was just order book and support tickets, right? Which I think in their mind constitutes enough, right? Should it? Maybe, right? But I don't think that we have a good sense of what it means to be in control of these different things. Like, where's the boundary? So if you ran out the Delta, but you didn't run the order book server, you're okay? I mean, are you operating a national exchange that requires a license? Or is somebody else operating? Or is it a national exchange that requires a license that's operated by nobody, right? I don't think we're far off from these questions, and I don't think they're necessarily great answers at the moment, other than regulatory arbitrage, right? Which I don't think is what anybody's looking for, and it's not a great answer.
Interesting. Let's switch gears now to investing. So we've seen traditional VC investment in the blockchain space, but we've also seen new investment vehicles like ICOs, SAFT, STOs. Where do you think we are headed next? And do you think ICOs are a thing of the past?
I mean, I think there's still ICOs that are happening. They're just not happening in the US, which, fair enough, right? There are other jurisdictions, Switzerland, Singapore, Malta, Gibraltar,
which are more friendlier.
They're just clearer. The definition of security is a lot more understandable. And so there's less uncertainty, right? In Switzerland, I think, and I'm not a Swiss lawyer, so this is not legal. None of this is legal. That certainly isn't legal advice. I believe in Switzerland, even if you were a security, it's just it doesn't have the same sort of consequence that it would in the US, right? In this market. So there's just a lot of differences between how that happens across jurisdictions. So ICOs, I don't think they're dead, because I think there's a market for these types of things. Will we ever hit the super frothy peaks of 2017? I mean, who knows? But maybe not with, maybe ICOs is not going to be the driver of that. There is an issue though, right? How do you, if you want to create a new blockchain network, you're going to create these scarce digital objects, and you're going to create the common space to support them. How do you distribute them widely to the public, particularly in systems like proof of stake, delegated proof of stake systems, where that distribution is absolutely essential to the function of the network?
Yes.
How do you do a fair distribution to make sure it's widely dispersed without being an intermediary? And in other types of markets where you see stuff like this, like spectrum allocation from, electromagnetic spectrum allocation, things like that. We went from the FCC, Federal Communications Commission, having a lottery system, right? Like, you put your name in a hat and maybe you get drawn for a license, to an auction system, right? It's clear that the auction mechanic does serve a purpose in distributing those scarce resources, right? Is the auction mechanic the correct way to do this too? I don't know, but it would be a shame to just say that, because it implicates these other regulations, even if you can do it in a fair way, where investors have clear disclosure and they understand what they're getting into, and consumers are getting the thing that they signed up for, and there's no consumer risk, that we still can't really do it. And we can't access this the benefits of this technology. I think that it would be an unfortunate place to land. So there's actually a problem that needs to be addressed in terms of how you distribute these tokens, whether it's through the ICOs that we used to see in the past. And there was a lot of different models and a lot of different approaches, and people are still experimenting with different ways to distribute these things. I don't know, but it's probably going to be something. So they're not dead. I don't think that's where investors are heading, right? And I think most of the investor action is in equity rounds,
right?
For people who are building out tools and infrastructure and things like that.
Interesting. So, given your background in Bitcoin, do you think any other cryptocurrencies that interest you are better delivering the promises made by Bitcoin? Any other projects that you find exciting?
I mean, I think Bitcoin is Bitcoin. It's sort of like its own unique thing. Years ago, I was at a conference, Scaling Bitcoin, and somebody came up to me. I have no idea who it was, so I'm trying to attribute it fairly, but I have no idea who this person was, which is perfect. It's Bitcoin. And he said, "You know what makes Bitcoin special? It was the first naive blockchain." Naive. And I was like, huh, right? In the sense that when Bitcoin was launched into the world, nobody really thought it was going to be anything, right? Even people who worked on it, even if you're into Hal Finney stuff, I don't think he was like, well, this is it.
This is going to happen.
It's completely done, right? Put a bow on it. Or it's going to have tons of value or any of that stuff. There was just no understanding of it being like a game for investors and rent seekers. And that obviously changed post-Bitcoin. Once people saw, whoa, this thing can actually be worth money, the whole game changed. And everything that's come out since then, there is a sort of I hate to say coin operated, but like, there's a coin operated mentality. And it's fine, it's fair. Like, people should be rewarded for their entrepreneurial effort and skill and all of that. But it's a little bit different. So every other blockchain that's come after it has had sort of a different approach. It also means the security stuff is different too, right? You have to be much further along than Bitcoin. I mean, if we operate in a different world where people know these things have value, that means attackers know it has value too. So you have to have a better grasp of how to deal with crypto economics and different types of attacks. It's a different ball game now. It's a different ball game. So I think that makes Bitcoin special, not just because it was a cool story, but I think it was embedded in kind of the ethos of the community and things like that, that there's something special about Bitcoin and we should preserve that, right? It's, got the highest difficulty. It's it's got the most censorship resistance. And people are really trying to just focus on those core values that makes Bitcoin Bitcoin and what makes it special and different from everything else in the world. So I think everybody else is trying to fill other gaps, like more privacy focused or adding computational bundle to it or other things. And that's cool, right? Like, that's innovation. And I think they can all coexist. In fact, I think they all make each other better.
Yeah,
But I don't see anybody out doing Bitcoin for Bitcoin stuff. It just sort of, it's like a phenomenon that happened.
That's very interesting. So as an angel investor, then how do you approach investing? What do you look in projects when you invest?
I try to find people who are smarter than me, which isn't hard, so that I can learn something. Yeah. But I mean, it sounds cliche, but it really is about the team and the people around. Do I believe in them? Do I think that they have the right balance between business sense and business skill, but also like an appreciation for the opportunity, the unique opportunity they're trying to create, and sort of viewing it more as a mission, right? You don't want to invest in fanatics who are just mission focused, and you don't want to be invested in people who are just like hedge fund managers, right? There's some happy medium in between where you have a mission, you want to change something, you want to make the world a little bit better in a certain way, but you have enough business acumen to actually be able to sustain it over time. And it's hard to find groups of people who actually have all of those things. When you do, it gets you excited and you want to jump in and hopefully help. Sort of, for me, the ideal kind of investment. So a lot of angel investing is like spray and pray, which is actually a very sensible way to do it, right? You're only deploying little bits of capital. You want to like get the biggest return you can on your capital, probably without a lot of follow-on or anything like that. So, get in early, get in often, right? And who knows, as long as they meet like a baseline, like this is a credible team, like just throw a little bit of money in the pot and spread it out.
See what happens.
Make 20 investments a year.
Oh.
And fingers crossed, like one of them becomes Uber. And that's actually a very sensible way of doing it. It's not what I'm doing. I'm a little bit more focused on where I can add value, right? So I talk about the team, but the other piece is where can I sort of add some value that other people probably can't. So that's connecting people to the right service providers in the legal industry and accounting industry, things like that, consultants, things like that, helping map strategies so that you can get around some of the tricky parts of where that regulatory perimeter lies, whether it's moving in or moving out, and managing that, things like that. So it's, the simple pitch is you can pay me a lot of money to be your lawyer as outside counsel, or I can pay you a little bit of money and participate in your upside. And I can't be your lawyer and I can't give you legal advice, but I can definitely help connect the dots for you. That's right.
That's pretty interesting. So as an attorney and a researcher, I'm sure you've seen a lot of statistics and data around the space. Are there any interesting facts that you would like to share with our audience about blockchain or cryptocurrency in general?
I think all of it's interesting. I mean, the whole thing exists. That's interesting and weird. Yeah. I think it's sort of crazy. I mean, maybe I'm just an old guy, but like when I sit back and I look at how the space has evolved, not just from when I entered it, but even from before that, right? We were working on virtual economies and things. And the idea that you could have that as like some distributed digital commons, like managing like all these like basically digital objects, their property out there in the ecosystem, and develop a whole economy around it, a whole ecosystem. It's crazy. Even it's small today, but like the fact that it exists at all is...
For 10 years now.
For 10 years. It's amazing. It's still like, I'm still in awe of it.
Let's talk about institutions. What are your thoughts on the need for KYC to work within the traditional financial system that we have?
Yeah, I mean, so globally, you can see that there's a little bit of a fracturing between standards around securities law and investor protection. That is not the case when it comes to anti-money laundering, counter-terrorist finance, and illicit finance. That is, everybody is moving the floor up, right? And you're not going to see, if there is an arbitrage around KYC that exists today, it will be closed. Yeah, guaranteed. It is too serious an issue, and people are not. It's just not. It's the kind of thing, and it's the kind of problem that has to be addressed at a global scale. It's a systemic issue, the movement of illicit funds, whereas investor protection is not, right? you can totally justify why one jurisdiction might say, our investors are willing to
take the risk,
do disclosure in a different way, right? Or take a little bit risk, or we want to be a little more forward leaning into the risk, right? When it comes to investor protection, that makes sense. And it's okay to have smaller markets that have a little bit of a variance in that. But when it comes to solving for illicit finance, it's a global issue, and it requires like a global floor in terms of standards. So that's a long-winded way of saying, if you want to get into the game, you just have to meet those standards of being a responsible actor in the global economy. Now, as I think there's another question, which is, are we using the right tools to prevent illicit finance, right? And I think that there's a lot of room for improvement there, right? I don't think that the way we conduct KYC, that the way we monitor transactions and report things, I don't think it's the most effective way of preventing financial crime or terrorist financing or any of those things. And I think that there's a ton of opportunity to do that in a better way that better balances the right to privacy with the need to stop this global systemic problem. So I think there's a lot of innovation that can be done there.
What do you mean when you refer to the tools? Which tools are you?
Well, so currently, if the way, say, the Bank Secrecy Act works in the US, it's up to the intermediaries to identify their customers, monitor transactions, and file reports. The reports are typically after the fact. Right. So a thing happens, there's an incident, you file a suspicious activity report, it gets filed, it goes away. Most of the time it's too late to intercede. Now, a lot of like cryptocurrency exchange operators and people like that, they'll have a connection to somebody in law enforcement that they can signal like, hey, you should be aware of like this thing that's happening. You can't reveal a SAR, but like they can make them aware of different things that are happening and bring law enforcement in. But there isn't sort of a direct line, right? It's very indirect. And so SARs typically are used as evidence and support. It's
after the fact.
After the fact. So I've caught somebody, they've done something wrong. Now I need to prove it in court. Then I pull the SARs and I use it as a chain of evidence. Sometimes they're used as investigative tools, but not as often as they could be. That's one example, right? How do we make that a little bit more real time? The second piece is I'm doing this in a silo. Now, there are information sharing agreements between banks and other financial institutions that allow them to share certain information, but you still have data, and anybody who's familiar with working with data, if you have a big pool of data that you want to collect from, but you're siloing it and you're reporting from this discrete level, you're never going to get the whole picture. Right? And it's a horribly inefficient way of conducting these things and handling it. It's also really invasive when it comes to my personal privacy, because now I have to submit ID paperwork everywhere I open an account, right? I'm going to probably have to trust somebody with it, but it's one thing to trust one entity with it who can be responsible for it, rather than dispersing that responsibility amongst a group of people, some of which are startups who, if somebody just opens a Bitcoin exchange and like, I don't want to say a jurisdiction for fear of offending somebody, but somebody wants to do some random cryptocurrency exchange and they're like, send us your passport. And it's like, really? I don't know if I want to send you my passport and all my tax documents. And like, I don't think I want to do that. And I understand why they need that from me, right? But that's all because everything's been pushed down to them in terms of identifying the customers, mining that data, watching my transactions, and filing reports up the chain. I'm sure there's a better way of dealing with this.
So it's pretty inefficient and siloed and repetitive in the nature.
Repetitive, privacy invasive. There's better ways of doing it, I'm sure. And I understand it's because we're working backwards within a legacy system. But it begs to be refactored in a new system.
Definitely.
Deployed better.
Yeah, agreed. So like just switching gears, so what do you think are the biggest misconceptions or blind spots that institutions particularly have about the cryptocurrency space?
So I think a lot of institutions are coming up to speed on this stuff. I think the biggest problem, I don't know if there's like a single, like this is the big blind spot. I think the big challenge is that there's just a dearth of reliable information, right? There's so much, there's crypto Twitter and all this, and there's like data, rumors and crazy stuff. And if I believe crypto Twitter, like half the people I know are in jail, right? Like not because I know a lot of criminals, because like everybody's in jail at some point on crypto Twitter, right? Or is on some horrible, it's crazy. It's this huge rumor mill and like gossip mill. And I'm sure I'll be flamed on Twitter for saying that, which is what Twitter was built for, I guess. But there's a lack of really good information. And there are different publications that are out there that specialize. But even with that, there's just so much PR and sort of nonsense that's being spewed. Getting to the actual meat of it is really difficult. And so people will read things and be like, wow, the blockchain is this magical, immutable technology that can solve all the problems in my organization. And you're like, yeah, right. And it's like anybody who's been around the space, just like giant eye roll when you hear all that stuff. And you think like, well, that person just doesn't know what they're talking about, which is true. But it's also, can you blame them? Like 99% of the literature that's out there repeats these ridiculous claims about how these systems operate.
Right.
And so I think we just need to do a better job in terms of getting to like a proper taxonomy and pushing like people to be a little bit more diligent in terms of what they say, how they talk, and holding people accountable for saying ridiculous things.
Yeah, so when you talk about taxonomy, I think you've done a great job about explaining some of the concepts in the past, and you've at some point said Bitcoin is not money, but it is a classic example of Coda's law. Do you want to elaborate that for our audience, what that means?
Sure. I mean, money is, at least, so when you think of like in the US, money has a very specific definition when you're talking about US money, right? It's the US dollar. Right. And there's nothing else. Other jurisdictions actually have things like concepts of private money and things like that. So, I'm a US lawyer, right? In the US, it's not money, right? Money is like a type of property that has magical powers, right? And there are two major magical powers. One, you can pay your taxes with it at the federal level. And two, liens don't attach. So I can't attach a lien to money. If you steal $20 from me and hand it to our wonderful producer over here, I can't sue the producer to get the $20 bill back, right? Lucky you. But I can sue you for $20 in damages, right? That's not necessarily true with any other form of property. If you steal my bike, and you sell it to our wonderful producer over here and he gives you $20 for it, I could probably sue you for the economic harm, but I can actually sue to get the bike back from him, right? A lien attaches. And so that's one of the magical. Now, Bitcoin has like some defenses against liens that are very technical, and I'm not going to bore everybody on this podcast with right now. I think that's one of those big myths that institutions have bought into, is that Bitcoin has a lien problem. It does not. Correct. So, but it persists. It's a like rumor and a myth that just persists throughout the ecosystem by people who don't understand how it works.
And the Coda's law part.
And the Coda's law part. So not Coda's law as the DAO founders would state it, which is like ridiculous. I was talking about the DAO the other day, and I love the DAO. It's like my favorite example of like how things work and don't work in blockchain land, and it's just forever a go-to for me. It's rich in comedy, but it's like the DAO. The best way I can describe it nowadays is that it was both illegal and dumb, right? It's like they managed like the whole thing, right? They said, code is law, and there's no legal agreement here. Whatever the code does applies, and sort of like, well, then YOLO, right? Like, people are going to withdraw money from it, and it's a giant internet pachinko machine, right? And so they won. And, you have no moral justification to like take any other remedial steps other than suing the founders of the DAO for being stupid and conducting illegal, dumb activity. That's one version of Coda's law. That's what I'm talking about Coda's law in the way that Lessig meant it when he wrote the book, right? That there are certain technical architectures which embody values, right? And those values are sort of ex ante in the system, right? And Bitcoin's a classic example. Bitcoin is a system that operates, it delivers these unique digital objects. They're rivalrous. They're rivalrous because of the rules of Bitcoin. And they operate consistent with those ex-ante rules, right? If I want to send you a Bitcoin, right, what I'm really doing is I'm just writing a script that I can redeem against the chain, and then, presumably you can redeem back at some point, but you don't have anything, right? You just have some ability to redeem, hopefully that nobody else can get to before you can get to. And those are like weird rules, but those are the rules of the system. There's no other real law that governs how that thing works. There's no terms of service, EUL, or any of those other things. And it sort of embodies those rules. And so, whether we're talking about Bitcoin and how Bitcoin develops over time, if we're going to swap in Schnorr signatures or something like that, we need to get community agreement on these different things. Or other blockchains as they're developed, it's being cognizant of the fact that you're developing rules that people are going to have to live by, right? And those rules sometimes function like regulation, and those rules sometimes function like law. So you can create a property system like Bitcoin that functions according to those rules, and it's going to look different from a property system that functions by a different set of rules. Even Ethereum is different, right? And that's cool because Ethereum's different. If it was the same, it wouldn't be cool. So, that's what I think we're really getting at when we say it's like a true code as law system. We've created this sort of self-regulatory marketplace for property where the state isn't really involved at that level. It can be involved at layer 2 and layer 3, but not at the root level.
So it's inbuilt in the system.
Yeah, those norms and those sort of ideas are embedded in how the system was built in the first place. It's really interesting. It's fascinating. Could Bitcoin become money for some people? Sure, maybe. In the future, like money is just property that is given magical powers by the government. The government could give Bitcoin magical powers if it wanted to. Unlikely. But
yes. Definitely. So over the last few years, you've seen and contributed to this changing narrative and public perception around cryptocurrencies. And we made this podcast not only for executives who, at institutions like Fidelity who are experimenting with the technology, but also institutions that are scared or not taking steps into the space. So what, according to you, is missing in terms of infrastructure/regulation that's holding these institutions back from getting involved?
Yeah, so regulatory clarity is probably the number one thing, right? So we talked about the SEC, and they're going to deliver guidance on token sales and guidance on qualified custodians and things like that, and custody in general. Like, those are big pieces. It's one thing if you're a startup. So everybody complains about the lack of clarity, but if you're a startup or an entrepreneur, it's to your benefit, right? That's just called entrepreneurial risk.
Right.
If you had a completely clear regulatory environment, if we knew exactly where the perimeter was, what was inside, what was outside, and the exact rule set in terms of disclosures and everything that would have to happen, then JP Morgan, Goldman Sachs, they would do it. Fidelity, they would all do it, right? And they have all the market share. They have all the customers. They would just own the space. They have the money. They have the capital and the resources. They would own the space. And there would be no entrepreneurial opportunity, right? So the lack of clarity is what enables, right? It's sort of the regulatory white space that enables innovation to happen. So I don't bemoan the lack of clarity to some degree. The structural stuff I think is problematic, but that timeline to get up to speed and understand, I think that's what gives entrepreneurs their edge to develop their piece of the market before the big institutional players move into it. But clearly it's the regulatory clarity piece. These are all heavily regulated institutions. A lot of them are effectively public-private partnerships. Banking is like the one space where I think the regulator actually cares how much money they make, in terms of they want to make sure they make money. I can't think of another regulated market where the regulator is like, are you making enough money today? So it's a quasi-public-private partnership, and they can't operate without regulatory clarity. And risk the franchise on some crypto crazy venture. Like, that's nonsense. Nobody's going to make that choice.
Right. And then in infrastructure, what's missing?
So I think in infrastructure, I've said for years that oracles are the new miners, right? I think having better data sources and things like that can externalize logic from dApps, that's critical, right? to extending out the effectiveness of all these different things. Custody solutions, I think, are really, really important. Like real proper custody solutions, not in terms of regulated qualified custodians, but things like wallet software and such that allows you to do more complicated things and do it in a more secure way. So better treasury control and things like that, both at the enterprise level, and since we're pushing so much risk to the edge to consumers, making sure that they're empowered through the software tools that they use to make better decisions. I think privacy is a big piece, right? Like we need better privacy dynamics in all of these systems. And you see some things that are being developed, Grin and Beam and some others, and of course Zcash and the others that have been around that are working on this problem. But it's clearly like critical, right, to make sure that we're preserving privacy on these networks so that people can actually operate. Sort of like HTTP to HTTPS. Like we needed the S, right? It's critical. And then just better exchange infrastructure and all the other key pieces of infrastructure that help the whole system grow, deeper liquidity pools and things like that. But those will all come along. But yeah, those are some of the big pieces.
So there's a lot to be worked in this space. There's a lot of opportunities, right?
Yeah, I mean, that's the best part of Crypto Winter, right? So this is like my, I don't know, third or fourth Crypto Winter. And
I'm fazed by it.
This is the best part. I love it. Like I live for Crypto Winter. I feel bad for people who lost money, of course, but like I live for Crypto Winter. Like it's the summer that's annoying. Like 2017 was one of the most annoying years that I've lived through in this space. There's just so much nonsense. There's just like anybody could get on CNBC and say like something stupid and everybody's just feted for doing it, right? It was nonsense. It was a big nonsense factory. Winter is great because like those people get shaken out. Serious people like buckle down and they build infrastructure, and all the tooling that's being built today is what's going to power the next big leg up. In terms of like awareness and use and those other things. Price, I don't really care about, it'll follow. But building the tooling is super fun, and that's what people are doing right now, right? This is the cool stuff. This is when like the future is imagined and like put to work.
Right. No, and that's exciting. I mean, we're building stuff, and that brings in a lot of opportunities for people to come in and build products in this space.
Yeah.
So I think that's a good note to and wrap this up. Thank you so much for sharing your thoughts with us today.
Yeah, it was my pleasure. Thank you for having me.
Of course. And thank you guys for joining us. We'll see you next month. The exchange is sponsored by Everbloom, a decentralized cryptocurrency exchange with the intelligence, liquidity, and trust institutional investors need.